Let's bring in Brenda Vingello, Chief Investment Officer for Sand Hill Global Advisors and a CNBC contributor, and Malcolm Etheridge, Executive Vice President for CIC Wealth and also a CNBC contributor. Guys, welcome. Good evening. Brenda, a big part of what low rates trained investors to do was chase risk because that was the only way you'd make any money. So how much shifting and rebalancing do you think most investors at home have to do in this new environment?
Well, I have a feeling that a lot of investors still have, what in our view, what would be too much exposure to equity. Either that or perhaps they put some money aside in cash and they're just sitting on that too, which you can earn a decent yield in cash right now. So it's not as bad as it used to be. But nevertheless, I think that this is a very interesting moment for a 60-40 portfolio. It certainly isn't dead. In fact, I think it is, from a risk reward standpoint, a great place to be, especially given the significant move that we've seen in interest rates. So in our view, we really like 60-40. In fact, we've added more to bonds over the last 6 to 9 months, so much so that we have an overweight to bonds and think you may even get an equity-like return on the bond side of that 60-40.
Well, okay, Malcolm, how do you think about this? It's a lot more fun, frankly, to talk about stocks. Like on CNBC, we probably don't allocate 40% of our time talking about bonds and fixed income because, stocks, there's companies, there's stories behind there that are a little bit easier to uncover. Strategically, when you look at how you structure a portfolio and where you put fixed income, what's interesting to you right now in this period?
Yeah, John, I think your point is a good one in the sense that the 40% of your portfolio that's traditionally allocated to bonds is supposed to be the boring part of your portfolio. That's why we don't allocate 40% of the market day to talking about it. And so that 40%, you're supposed to be able to count on, one, providing you a predictable rate of return over however long the maturity timeline is, but then also not hearing a bunch of noise from your bond side of the portfolio until it's time for maturity to happen and you to go find whatever that next bond is to replace it. So I think your point is a really good one, that as of late, we're having to do a lot more trading than we normally would, or for most of us, we normally would like to, trying to find those returns and trying to find that yield, because last year, 2022, the bond side of the portfolio just did not perform for us like it traditionally would. But I am in agreement with Brenda that I think we shouldn't just completely abandon the 60-40 because 2022 was a rough year. It was a rough year with a bunch of unique circumstances.
Indeed. And Brenda, there are also opportunities in, of course, equities right now. So to the portion of your portfolio that you are allocating to that, how are you screening where there's real opportunity right now? Is it the traditional, well, look at dividend-paying stocks, that have, a solid business during this time and don't really need capital? Or is there more that you're putting in based on what you see happening geopolitically and in the economy?
Sure. There's a lot going on. And so we have to look at what worked last year, too, and not just assume that that's what's going to work the best this year. Many of those more defensive sectors and stocks are pretty expensive. And I think in this environment, when you can earn 5% in a 6-month T-bill, valuation matters. So when we look at screening across the board, across the equity universe, in our view, things like small and especially mid-cap equities in the U.S. are looking a lot more attractive. These tend to be much more domestically focused companies. They tend to be nichier businesses where there is an opportunity to maintain pricing power regardless of the environment. So we think that that part of the asset class is really interesting. Also, if you look into the international side, certainly a lot of fear all the time about China, and some people calling the market uninvestable. But we think there is an opportunity there as well when we look at China as being one of the only major economies that's stimulating its economy, and also the growth opportunities that are there, the significant amount of savings that the populace has built up over the last several years, which could result in better economic growth and earnings growth for companies there. So we think being diversified is important within that equity side of the 60-40. We're not completely abandoning large cap stocks in the U.S., but we have a neutral exposure there right now because we think that valuation is okay, but not incredibly attractive versus some other parts of the universe.
Malcolm, Brenda makes a really interesting point about diversification, of course, within equities themselves. When we talk about international, sure, investors out there could just do an international index fund and get a bit of everything, overall international, or you can go by geography, by region, and you gotta, I guess, be aware of the different risks and opportunities by region. How are you focused for international right now, given the concerns about China, and then given also what's happening in commodities and with interest rates and inflation across the board?
Yeah, so I actually think, we started off this conversation talking about the 60-40 portfolio, and the traditional 60-40 is 60% allocated to U.S. large cap stocks and the other 40 to U.S. corporates. And so I think it's important to also point out that the S&P 500 is basically our mechanism for determining the 500 largest and most important companies, U.S.-based companies. But a third of those companies in the S&P all have international exposure. So it is very much possible to still get exposure to the international sectors that you want to get access to, all of the different countries around the world. Apple does a tremendous amount of business in China, for example, to your point, right? So if I want exposure to China, that's one way to get exposure to the Chinese consumer without having to decide which are the right international funds to be putting money into, or which are the right international companies to be putting money into, with the concern that there may be some geopolitical risk that I don't even know exists right now that suddenly crops up, and that money's either locked up or negatively impacted. So if I'm the type of investor who's concerned about being allocated in a well-diversified portfolio or a 60-40 balanced portfolio that says that I'm probably of moderate risk appetite, maybe I'm content with having exposure through the S&P and not taking the additional risk of adding in an international fund or ETF like you mentioned.